Today, I'm going to talk about hedge funds. The hedge fund industry is, as I think I mentioned last week, is just another group within the asset management industry, which is one of the five main pillars of the financial sector. So the financial sector, banking, insurance, asset management. And then within asset management, as we saw last week, is typically done through investment funds. And investment funds have different characteristics. You can have mutual funds, you can have ETFs, you can have other things. Hedge funds are of interest to us because they are a type of fund, investment fund, that has no regulatory restrictions. A hedge fund, as we saw last week, can do anything as long as they tell the investors and the investors are happy with it. That's it works. Mutual funds have restrictions. They cannot do certain things. ETFs have restrictions. They need regulatory approval. Hedge funds do not need regulatory approval for what they do. What they need is two things. They need to be legal, which means they need to be set up according to the securities laws of the country where they operate or where their clients live, and they need to, of course, respect securities regulations. Within that, they can do whatever trading strategy they want. That's what I'm going to be talking about today. And the interest for us is that here we're going to find the most innovative, the most interesting trading strategies, just because they have no restriction. The characteristics of hedge funds, so what makes a hedge fund is that they usually take advantage of either market inefficiencies or information advantages. We already saw an example last week when we showed up at the negotiating table between the city of Montreal and the ski resort, and we offered them a deal that they were about to walk away from. What we did is exploit what's called a market inefficiency. There was a chance for some efficiency to be created. The market was inefficient because the swaps they wanted didn't exist. We created those swaps, we created those agreements, and as we saw last week, we got compensated for that. That's an example of a market inefficiency, and hedge funds, that's what they typically do. They figure out ways to take certain risks into consideration that the rest of the market is not. And the other is they can use information, they can take advantage of information advantages. So they can take advantage of information that they may have or they may think they have that other people don't. Now, this is not to be confused with insider trading or another aspect, which is also illegal, which is MNPI, to use material non-public information. That you cannot do. No one can do that. Hedge funds cannot do that either. That's illegal. That was regulated in the Inventors Act of 1933 and its sequel in 1934. So it's been legal for almost 100 years. That is not what I mean by that. What I mean by that is sometimes they have access to information networks. For example, if a company is about to market a new drug, for example, they would be going around asking doctors for their opinion, maybe asking patients, and then they will have their own information view from their activity, and then they come up with a decision whether that's a good company to buy or a good company to short sell, for example. And we see examples today as to how that works. So that's what will define hedge funds. They always take risk into return. There's no such thing as investing without risk. That doesn't exist. Okay, and so their sources of return are because of the type of risks they take. And the example we saw last week with the Snow Fund is a very good example to understand how risk can be taken into return. Usually, their return is not linked to market direction. We already saw that in our Snow Fund last week. Whether the stock market goes up and down, the cash flows for our fund are not going to depend on that. The cash flows for our fund will depend on whether there's snow precipitation at a ski resort or in the city. The direction of the market or the direction of interest rates was not of particular relevance for what we were doing. Okay, it does affect us. It does affect if there's a very big crisis in the market, then IntraWest can go bankrupt, and then, well, our swap payments will be affected. So when we are part of the financial system, these things affect us, but we usually don't know in which way they will affect us. If the stock market goes up, that it's not clear if that's good or bad for us. If interest rates go up or down, it's not clear if it's good or bad for us. It's typically good in that case, because after all, we had a lot of money collecting interest on a bank account. So that would increase our return. We'll see today that sometimes we're going to be leveraging our investment strategies, which means we'll pay more interest if rates go up. So it's not clear how hedge funds are affected by market directions. The objective today is to understand a number of trading strategies and understand how different behaviors in the financial sector will affect each of these trading strategies. Hedge funds are able to trade exchange-traded securities like stocks or not. A snow swap, for example, that was not an exchange-traded security, they could do it. Mutual funds, for example, cannot do that. ETFs cannot do that. Other investment funds cannot do that either. That's another reason why we look at hedge funds, because by looking at hedge funds, we are unconstrained as to what we can do. So to learn how investing happens, it's the right group to look at, it's the right group to focus on. Another thing which is important is to understand how they may have what's called a limited opportunity set. We also saw that in our example last week. We could build an investment fund for $2 billion with 100 snow swaps, but then we saw that if now we have a lot more money coming to us and we could invest $4 billion, we don't have enough swaps. We run out of all of them. That is typically not the case for mutual funds who have so much access to investment opportunities. Stock markets are much, much larger than the typical mutual fund. That's not a consideration for them. You give money to a mutual fund, they can always invest it. You give money to a hedge fund, it's not clear they can always invest it. So you give money to a mutual fund, they can always invest it. You give money to a mutual fund, it's not clear they can always invest it. It's called a limited opportunity set. They may also have liquidity restrictions. Example, the snow fund. We will have an agreement to clean up if we have an agreement to compensate, say, the city of Montreal, if there is snowfall in April, we cannot walk out of that agreement typically in February. There will probably be a clause that says we cannot leave for, say, a year or until a time which is mutually agreed. If we have investors that give us money to invest, we can't always promise to our investors that they can get their money from the investment fund whenever they want, because then the fund may have a drawdown that may impact the agreements we have in place with our counterparties. Okay? So this typically translates into liquidity restrictions, as we saw last week. And oftentimes they are innovative. They were considered to be very innovative in the 80s when they started. The hedge funds date back to 1950. That's when it is said that the first hedge fund was created. But really they started to grow as an investment group in the 80s, when they became also very famous. But even today, if you don't do something innovative, very likely you're not going to have access to either market inefficiencies or information advantages. So the chance that you can make any money is very low. This is the reason why hedge funds are typically innovative, and they like to do things before anybody else knows what they're doing. Here's a scattergram of different trading strategies. I'm not going to spend any time on this today, just to give you an idea that first of all, hedge funds are grouped into strategies, as we will do today. If I'm lucky, I will do 3 strategies today, 1 per hour. And each strategy gives rise to a very different return risk profile. Some strategies have higher risk and higher return, others have lower risk and lower return, and others can be all over the place. So if you look at this plane that I have here, this risk return plane, you can see dots. The dots correspond to the expected or average return and average risk of each of those strategies, and you can see that there's somehow all over the place. Now, there's one thing to note here, which is that if here you plotted your typical equity index, for example, it's going to be off the charts in terms of its risk. In other words, the standard deviation of hedge funds is typically much, much lower than the standard deviation of, say, for example, an equity index or even a bond index. From a standard deviation perspective, hedge funds are much more tame than most other investment funds. Okay. But we're not going to spend time on this today. I'm going to spend time instead walking you through 3 investment strategies so we understand them well and we see how we could take advantage of certain situations in the market. I have here a list of the strategy breakdown from the assets under management perspective. I want to give you an idea how big these strategies are. For example, we may have, we're going to walk through some of these. There's a strategy that is very much talked about, for example, the high frequency trading strategies. It's very talked about, but there's very, very few assets involved in that. In fact, it doesn't even show up here. We are going to see that a lot of the strategies have to do with equities, equity long only, equity long short, equity long bias, equity market neutral. We're going to see today how the equity strategies work. We're going to spend a good amount of time on equity strategies, and you will see they're very different from what a mutual fund would do. And in doing that, we will see how quantitative methods and math enters into that, but we'll also see how other things which are not math enter into that. Okay, so don't think that these strategies are driven by algorithms. That's another typical misconception, to think that hedge funds, they run algorithms. Sometimes they do, but sometimes they don't. The innovative aspects of what they do is not always linked to mathematical formulas. And I want you to learn that too. We will see other strategies. For example, we're going to perhaps mention the macro trading strategy. I'll explain to you what it is. It's something which is accounts for about 8% of the market. We're talking about a $4 billion market, so 8% is like $1 billion. So it's like we're about a $4 trillion market. So 8% of that is like 3 trillion. It's 3 billion is still a very big amount of money, right? Merger arbitrage, I may mention something about that. So these are some of the strategies that are typically mentioned. My objective today is that you learn what is behind some of the names which are here listed. Equity is the most important one. Equity markets are also the largest, and equity markets have another advantage, which is that they contain exchange-traded securities. Exchange-traded securities have an advantage over, for example, bonds, in the sense that the amount of information is higher. You know at what price each stock is trading all the time because they trade on exchanges. And when you need to execute a trade, you go through the exchange. If you're trying to buy or sell bonds, for example, you don't do that. There are no bond exchanges. You have to go through a broker, and the information available there is less. We will still deal with bonds today. in the way I will explain some of these. So on the equity side, there is five types of trading strategies that define how managers, fund managers, traders, how they look at stocks. The first two are given by what's called fundamental and growth, and they're really opposites to each other. Fundamental equity is when you look at a stock based on their fundamentals, their financial fundamentals, their accounting statements, their financial reports produced quarterly. Investors in this type of stock, what they do is they would look at a company and they would go through the financial statements, and from there they would get a sense whether this is a company that is worth having or not. An example of a fundamental equity investor would be Warren Buffett, for example. Growth is different. Growth is an activity where you look at a certain company, a certain stock, and what you're looking at is not what it is now, but what it's going to be in the future. It's a forward-looking exercise. By analyzing the company, their financials could be terrible. They could have massive debt. They could have very few revenues. But say, well, you know what? Like, I don't care. I think this is a good stock to have, and you buy it. Example of that, Facebook. When Facebook did the IPO, many investors bought this Facebook stock, and it had no revenue. Okay, and they paid billions of dollars for the company. Why? Because they thought the revenue model was so interesting for the future, despite the fact that it didn't really have any revenue when it went into the IPO. Understand? A fundamental investor will never do that. The fundamentals of Facebook pre-IPO look terrible. The perspective looked great. And that's what distinguishes the fundamental versus the growth traders. That's clear? Yeah. I mean, if you do any stock trading, you would know that. And then between the two, they say there's an intermediate style. It's called a GARP. It's growth at a reasonable price. And these are managers who understand the fundamental, who understand the growth aspects of that, and they like to have a combination of both. It's like a blend between fundamental and growth, and it's called GARP. And by the way, everything that I'm telling you today, as you will see, there's a lot of gray areas. And that's where the interest is usually. It's in the gray areas, in things which are not really here or here. They're somewhere in the middle. And GARP is an example of that. Now, momentum trading is different. This is typically done by managers who want to take advantage of a sudden, rapid growth or decrease of stock value. I have an example here. It was one of the typical examples of a growth stock, Netflix, in 2013. Netflix in 2013 was a new company, was starting. It was 10 years ago. And there was a lot of talk about Netflix, whether it would become what it became, or whether it was just a short-term something. But for a while, it became a momentum stock. It increased in value of over 260%, very, very rapidly. In fact, the CEO at the time, Reed Hastings, he actually admitted that Netflix was a momentum stock. That's very rare for a CEO to admit that the stock is a momentum stock when it goes up. Okay, when it goes down, perhaps, but not when it goes up. Basically saying that the stock is going up not because of him, but because of the market. So it is an example of that. When you see a stock that's going up, the idea is you buy it, and you try to guess how long that momentum is going to last, and you try to sell before the momentum is over. So you don't buy the stock because it has great fundamentals. You don't buy the stock because it's growth potential for the future. You buy it because everybody else is buying that. Another good example of that was GameStop. Was definitely a momentum stock. There the momentum lasted just a few hours, days, maybe a week most. These are all examples of momentum stocks. And momentum stocks, it's very important for me to mention a momentum now, because one of the One of the things that we see which are on the rise are socially driven situations, okay? And perhaps momentum is going to become much, much bigger because of our ability to predict where investor sentiment is going to. For example, you could have a large language model reading Reddit in real time and telling you, hey, everybody's going to buy this. Oh, hey, everybody's going to sell this. And then you can trade as a function of that. You can have a large language model basically alerting you to momentum trades on the up or on the down side, right? So AI is going to make this much bigger. I also think that AI is going to make technical trading bigger. Technical is, I don't know why the text is below the charts. Anyway, you can guess what it says there. It's not important. Technical is, it's an old strategy. People have developed a way of looking at a chart and coming up with magic numbers that would indicate whether a stock is going to go up or down because it's it just hit 10% from the previous high, so that's a signal that it's going to probably continue to go down until it's down by 20% or things like that. Okay, this type of rules of thumb that many people have been very fond of for decades is what technical trading is. Now, of course, a lot of these things that many investors don't have appreciation for or respect even for. These things are now changing. We don't know how they're going to change. In principle, you could think that what technical trading was just a human version of a neural network. Right? Someone was just coming up with rules. So, well, when this rule happens, then the market does this or the stock does that. Right? Now, if you look at it from that perspective, you could say, well, maybe there is more to it than that. Humans will be very bad to implement technical trading, but computers will be better at detecting rules that are just there all the time and we've never detected them. So that's a possibility. What's also a possibility is that these rules that may exist may be very short-lived. For several reasons. First, because there's a lot of people looking for rules out there. So there's a lot of what's called predatory trading. People think that people are trying to find out what it is that is driving your trading algorithm, and then they try to trade against you without you knowing what that happens. Okay, so you actually have algorithms trading against other algorithms, trying to understand. So this area is also very interesting, but it's still both of these areas that I'm mentioning, they are still in very low AUM. They're interesting, and for the future, who knows? Maybe the big trading participants are all going to be machines. That's very likely, in which case, who knows, maybe momentum and technical, they become the biggest. But right now, they're not. The biggest is fundamental and growth. Okay, so a lot of these styles that are listed here, they are listed by relevance, by the AUM that represents those strategies. But watch, because these things could easily turn, very easily could turn. Now, on the fundamental side, what a fundamental trader would do is they would look at a number of stocks. I have here some stocks, five stocks. I have Apple, Microsoft, Verizon, HP, and Alphabet, okay? And say, well, I'm going to create a technology fund. I'm going to look at these 5 stocks. Which one do I want? Fundamental managers don't really like to look at technology stocks because a lot of the juice in technology stocks is not in their financials, okay? But I still use that for this example today. So here there's a number of quantities, and I got this from probably Google Finance. This is this information which is available, and of course, if you go to Bloomberg, you get this information in a much richer way. So you look at a company fundamentals. So the price of the stock is there. That's what the market is telling you. Then it tells you the change from yesterday, blah, blah. All of that. And then you have quantities which are relevant for trading. For example, earnings per share. What is the earnings per share? Earnings is what the company earns. It's in the financial statements that they disclose quarterly, right? Which is typically expressed in millions or billions of dollars. You divide that by the total share value of the company and it gives you the earnings per share. It's a good way to understand what this company is making on a relative basis to the share price. For example, in this case, I have Apple has earnings per share of 8, has a lot of earnings. On earnings per share, Apple is better than Microsoft. They make more money than Microsoft from an earnings perspective, right? Of course, growth manager will say, no, I don't care. In fact, Microsoft is the stock to buy because I think their future growth is going to be better. We will see how they do that next, all right? But that's what earnings per share is. So in this case, earnings per share of Apple are the largest except Google. Google has the largest earnings per share. So from an earnings per share perspective, if you're a fundamental trader, you say, oh, I want to buy Google. Maybe Apple, the rest I don't care. See? From an earnings per share, what's PE? PE ratio is price to equity. You say, well, wait a minute. The equity of my company, which is in the financial statements, thus is not really in line with the price of the stock. So from that perspective, Google is a very expensive stock. You see, there is no contradiction between the fact that they have the highest earnings per share, but the price to equity is, so from a price to equity perspective, I will be actually disinclined to buy Google. You see what I mean? And that's what managers do. Well, I think for Google, what's relevant is this and not that. You have to take your pick. For earnings per share, you could say, well, given what I saw there, actually Microsoft is the best company to buy, right? 30. Sorry, what I'm saying is the worst company to buy. So Google is bad and so is Microsoft because it's very expensive. The price of the company divided by the equity that the company actually owns is very low. It's very high. The price is very high, right? So you're going to buy the cheapest. The cheapest will be HP or Apple, right? So you continue with this financial picture for all the companies, a price to sales ratio. And here you can see that the price to sales, actually HP will be the best buy from a sales perspective, right? And so on and so forth, right? And so on and so forth. So you can look at the company fundamentals, the company financials, and then make investment decisions on the basis of it. That's what fundamental investors do. Is that clear? The amounts that they look at is, this is going to come up in the wrong way. So they will look at the price to book, as we saw. EBITDA is another quantity that shows up. That's earnings before income tax and appreciation. Debt and appreciation, okay, it's another accounting term which is used for traders to look into this. And here is for fundamental equity trading, knowledge of accounting is important, okay? To understand this concept from an accounting perspective is very important, especially understanding how the accounting implies your activity. For example, the way you would analyze technology companies or banks is very different. Very, very different. Or a construction company. A construction company is a very capital-intensive firm, so the debt would become a very big deal. For a technology company, the debt is perhaps not a very big deal because to make 10 times the amount of money, they don't really need to deploy any more assets, right? They just need people to buy more licenses. They have a much more scalable business. So this is what fundamental traders would do. Growth is different. They do look at financials, but from a forward-looking perspective. So, for example, one of the quantities that they look at is what's called historical growth strength. Historical growth strength. So you look at the growth numbers of the company over a period of time, say 5 years, and for large companies, if say over $4 billion in valuation, if the growth has been at, say, constant in excess of 5%, then you say that has a very strong growth potential. It's been growing at a good rate for a number of years. If the company is smaller, you impose a higher return. So, for example, companies which are less than 400 million is typically the threshold for a growth rate would be 12% per year over the last 5 years. Okay, that's what you would look at. Why? You look at the curve because you want to see the evolution of that into the future. You will look at forward earnings growth. In fundamental, we show earnings per share. That's a snapshot of the company now. It tells you how good the company is now. But here you're looking at projections over time, okay, with the target of, for example, 10%. If your earnings growth is going to grow at a rate of 10%, then it's considered to be good. Then you look at other things such as efficiency, costs, revenue, companies that reduce costs, companies that get into new businesses, therefore revenue is going to grow. All of these are forward-looking measures. Okay, an example that I have here is Microsoft. I'll just walk you very quickly through this. I don't want to spend too much time on this example, but Microsoft in 2003 was considered to be the paradigmatic growth trade. Okay, the earnings per share was growing at 5%, was growing well in excess of 5%. The 5-year average was at 16%, so that was very, very strong earnings growth. Then the projected average annual earnings was at 11% at that time, again very strong. And the costs and revenue control is very good. Look at that chart. And then finally, the return on equity, it's above the industry average. So all of these are things which would make Microsoft to be a growth trade. That's how you. So we have seen how fundamentals think. We have seen how growth traders do. GARP, as I mentioned, is somewhere in between. I'm not going to spend any time on that. You have to decide for a company whether the growth perspective or the fundamental perspective is what matters. You look at both, and then you make your decisions on the basis of that. And now I'm not going to spend any time on momentum or technical. What I want to do now is I want to go into one of the interesting aspects of stock trading, which is not when you go and buy a stock, but when you short sell a stock. I want you to understand how short selling works. Anybody has done short selling? Short selling? Okay. It's not the same as buying, and it's fairly easy to buy a stock. It's a bit more difficult to short sell a stock. Okay. So let me tell you how that is going to be very important. It's going to be crucial for us to be able to short sell stock. So what you should know is that there's no such thing as buying a negative amount of stocks. You cannot do that. That's not how it works. Short selling means you have to borrow a stock from an actual rightful owner and sell it. When you sell it, you collect cash. So the act of short selling a stock, it's involved. I'll walk you through this. You need to borrow it. Borrowing the stock generates a liability for you. You have to give it back, and you have to pay the owner of the stock. You have to pay financing rates and dividend payments. Okay? So say I borrow your stock. I say, well, this stock is going to drop in price. What I do is I borrow it from you, and then I sell it. When I sell it, I get cash. But I have to pay you every day until I return it. I have to pay you for the stock, and I have to pay you the dividends that the stock originates. Okay, so it has some cost to me. And then, of course, I have the obligation to give it back to you. The process starts with what's called the locate process, which is I have to find some stock whose owner is willing to lend it to me. This is why you do this through a broker. Brokers have an inventory of stocks that are available to be on loan. And they would know which ones are available to be on loan and which ones are not. Example is Morgan Stanley. I think they are the biggest stockbroker in the world. So you go to them and you pick a stock, and they have billions of available stocks for you to choose from to short. And when you short, they will do this for you. They will, all in a matter of seconds, they will locate the stock, they will sell it, you pick up the obligation, and you get the cash. Okay? Now, something which is interesting, it doesn't exist anymore, but it's important for historical reasons for you to understand an additional element that was brought into short selling stocks, which is called the uptick rule. Let me explain to you why this was introduced. It was introduced, like many of these regulations, in the Investors Act of 1933 and 34. And that was all a reaction, as we saw many weeks ago, was all a reaction to the stock crash of 1929. We saw an example in the stock crash of 1929 how someone, the CEO of the Manhattan Bank, shorted his own bank stock because he had access to information. That's illegal now, it was legal back then. But like that, there were other activities that the Investors Act was aiming to control. And one of them was to prevent stock price manipulation. How can I manipulate a stock price with shorting? What I could do is I could go into a market and I could start to short sell stocks, and then the stock goes down in price. And I do that in enough amounts so I create a momentum trade on the downside. Investors are all scared and they all start to short their stocks, they all sell, which is great, and then at that point say, well, I buy it back, right? And then I screw everybody. So as a way to prevent that example of stock manipulation, a rule was introduced. It was removed in 2008, strangely. But the uptick rule, what it says is that, say that you have a stock at 51 and you want to short it. And you give your order, you have the locate process started, I know the stock that I can sell, the stock is being awarded to me to sell, but I cannot sell it until there's an uptick. I cannot sell it, so if the stock price is going down, I cannot sell it. I can only sell it here when it goes from 48.5 back to 49. That uptick, this is the tick, these are ticks, okay? A tick is an individual trade. They could happen every millisecond. Okay, so I could sell it there, not here, right? Yes?
But you should be able to sell it at any point where the slope is positive, right?
Positive, yes.
You don't know when you're going to be at maximum.
No. You just need to short. You just need to sell it when there's an uptick. And the idea is that you cannot just short sell as the stock is going down. You have to wait for at least a buyer say, no, I buy the stock, then I can short sell more. It's a way to prevent stock manipulation. Of course, maybe in the 30s this made sense. The regulators determined in 2008 that it was no longer needed, so it was removed. This introduces a lot of operational complications to brokers. Okay, and anyway, so it was infeasible at that time. But I still give it to you because it's an important piece of history to know. Okay. And then something very, very important that I want to pay a lot of attention to today is the existence of what's called short squeezes. And this has to do with the following. If I borrow your stock, say your stock, you have a stock and I borrow it and then I sell it. If at some point you want the stock back, perhaps because you want to sell it yourself, then you have the right to ask me to give it to you at that time. And then I have to go and I have to get it and give it to you. Okay, this is what's called a short squeeze. Normally brokers, when that happens, if you get a stock on loan to you and the seller wants to sell it, what they do is they say, well, no problem, all stocks are the same, right? So they would give the stock back to the owner, you will get a different stock on loan, and then you don't even notice, right? They do that. They charge for the service. I mean, this is what they charge, all right? This is a service for which they charge, so that's what they would do. But there are situations when there are no more rightful owners of stocks who are willing to have them on loan. And that generates a short squeeze. And a short squeeze are things which are very, very deadly. I have I have an example coming up that I'll show you. Let me summarize what I've told you, and then I'll give you the real life flavor of how this works. So mathematically, it may seem that short selling corresponds to purchasing a negative amount of stocks. And for many application studies, what we do, and that's how we did it in part 1 of this course, but now it's time to learn that that's not exactly how it works. Okay, it's not exactly how it works. There's something else besides the buying process, and it has to do with the mechanics of that, which I'm explaining to you. Okay, so if the lender, and this is one of the most important pieces of life realization of this process, if the lender demands the stock back, they will have it back. And if there are no more stocks to be on loan to me, then I enter into a situation which will force me to buy the stock, typically at a very high price, and give it back to the lender. Okay, so let me show you the best way to explain the squeeze is what happened to the Volkswagen stock at the Frankfurt Exchange in 2008, and that's what I have here for you now. So I want you to understand this example very well. It has to do with the company Volkswagen. Do you know the history of the company Volkswagen? It's a very interesting history. Okay, so
What's the company produced cars for World War II?
oh, okay, almost. Yes.
They were involved in, I think, the emissions scam.
That too. Okay, so it all started with someone by the name Ferdinand Porsche. Okay, have you heard that name before? Ferdinand Porsche? No? Well, maybe you have not heard of Ferdinand Porsche, but you have heard of Porsche. Yes, the car. Okay, so Ferdinand Porsche was a car maker, made trucks, made tractors. I suspect, I don't know, but I suspect they made tanks too. Okay. And they had a very successful automobile company. During the Third Reich, Hitler insisted to appropriate his car making division and called it Volkswagen, which in German means the car of the people, Volkswagen, all right? And rumor says that Ferdinand Porsche made his heirs swear on his deathbed that they would not stop until they get Volkswagen back into the company. So this started before World War II. Volkswagen was a splinter of the Porsche company, was somehow appropriated by the government at the time, Hitler, and then brought into a company of its own. And Porsche always wanted to get it back. Now, so that's the backdrop. 2008 was the year of the big financial crisis, remember? And we already went through that when we looked at Goodrich. Cars were just not being sold. I think I mentioned to you a piece of in-plot market data, which is at the rate cars were being sold in 2008, people would be holding on to their cars like for 25 years. Okay? That gives you an idea of the sales number for cars. As a result, investors, growth investors, fundamental investors, momentum investors, everybody was short automakers. They were short GM, who went bankrupt. They were short Chrysler, went bankrupt. They were short Ford, missed bankruptcy by $1, okay? They were short everything. They were short Volkswagen too. Okay? Volkswagen trades on the Frankfurt Exchange, and it was a very big short. Let me give you an idea of the situation of the Volkswagen stock in Frankfurt on Friday, October the 24th. Okay? Friday, October the 24th, Porsche owned 42.6% of the company. This is what they've owned for historically. The state of Lower Saxony owned just over 20% of it. These are the big institutional owners of Volkswagen back then. Then there was 13% of the stock on loan for shorts, understand? On loan for shorts, which gives what's called a float of about 25%. Every short trader looks at the float, and you want the float to be a lot bigger than the average daily volume, right? What happens if not? What happens if not?
You run in a situation where there's no stock available.
Yeah, and then, right? So, and then what actually happened here would happen. But it was considered to be safe. 25%, much bigger than the daily volume, right? No stock trades 25% in there. That's a cataclysm. That's a lot, right? So 25% was considered to be safe. Okay? Every short trader would look at this number. Footnote, I read somewhere, I haven't verified, I read somewhere that during the GameStop event, a hedge fund was short like several times the available stock of the company. I heard that somewhere. I don't know, I couldn't verify that, but believe me, I know short traders. You always look at this number, okay? This number has to be, the float has to be orders of magnitude bigger than the daily trades. Forget about the actual stocks being issued. No one trades short on a blind manner, okay? No one. Even in this case, which is very interesting, people were still watching this number very closely. We were in this trade, okay? I participated in this. I was part of the short squeeze. Happy to tell you, okay? Now, on Sunday, October 26, the CFO of Porsche makes a public announcement on a Sunday. And the announcement is that Porsche had entered into an agreement to buy cash settled options on Volkswagen amounting 31.5% of the value, 31.5% of the company. That was an announcement made on Sunday. So let's say you are short Volkswagen and the CFO makes this announcement. What happens? I cannot hear you.
The price goes up.
Huh?
The price of the stock goes up.
The price of the stock goes up, except it's a Sunday.
Oh.
No stock trades on Sunday. So what happens then? Well, let's see, the reaction will be different from someone who is short the stock, someone who is long the stock, or someone who is just watching, right? The person who is just watching, that has an interest, okay? What do you do if you're just watching?
I mean, the first thing I would find kind of interesting is that those numbers are more than 100%.
Well, yeah, those numbers are more than 100%. If you're just watching and say, well, this is more than 100%, so then you say, this is something interesting. So at that point, you close your Netflix movie. This is far more interesting than any Netflix movie. Something very interesting is about to happen, right? Shut down your TV and turn on Bloomberg. See what's going on. It's a Sunday. It's a Sunday, right? Okay, so that's if you're like not involved. You're not long, you're not short. What happens if you're short?
I presume you'd freak out because now there's no more float.
Exactly. You freak out, and it's a Sunday. What do you do?
Stress and sad.
What do you do?
Can you do anything?
Huh?
What can you do? You can't buy the stock, can you?
Not on an exchange. Israel has an exchange that opens on a Sunday night. And some people went to the exchange in Israel to see if they could do something there.
So essentially, the situation, if you're a short seller, long the stock and longer exists, if I understand it correctly.
I cannot hear you very well.
So in this situation, if you're a short seller, or you shorted the stock, you've essentially loaned the stock that no longer exists.
No. The loan exists, and you're liable to bring it back if they want it. Okay? So yeah, no. If you freak out, if you're short, you freak out, right? It's a Sunday. What can you do? You start calling your friends. That's why I got calls, right? I was very busy that Sunday night, picking up calls and what's going on. We had a very small short position, but we were short. We were short from two of our managers. We were short, right? So I said, you try to find the stock somewhere. You call someone, hey, do you own Volkswagen stock? Oh yeah, I do. Would you lend it to me? I'll pay you like twice the amount of money, right? You try to do something. That's what people do. You understand? You freak out. What if you're long the stock?
You get excited because someone's going to try to buy it off you.
You get excited, exactly. And what's your plan? It's a Sunday. What's your plan?
I'm just going to wait and see what happens.
You're gonna be glued to that terminal on Frankfurt 9 a.m. when they open, right? Yeah? You picture this? So that was on a Sunday. Let's see what happened on the Monday. So Monday, October 27, Volkswagen rose, went up in price. Why did it go up in price?
Probably people calling on their loans.
People going on their own, exactly. So if you're short, you say, well, I need to buy that stock, right? So that causes, if you're long the stock, what do? You sell it? What do?
You hold it. You hold it.
You hold it, exactly. For how long?
At
Okay.
least more than
How-
2.5 times the value.
How much?
At least more than 2.5 times the value.
More than 2.5 times. So you would be waiting for the price to go up 250%, right? That's what you would do, right? Okay. So he has a sell order for 250% of the opening price. Yes? And then you sell. Yes? You call your broker and said, I forgot the actual price of the stock. I don't have it here. Say it was at 100. Said, well, when it reaches 250, you sell. That's what you would do, right?
An example,
Yeah. What would you do?
I wait 5 hours, see.
You wait 5 hours? You don't give a sell order?
I give a sell order.
You give a sell order.
300%.
300. So 250, 300. What would you do?
Probably 200 maybe.
200? You give a sell order for 200, right? Okay, so all of you who are long, you're giving sell orders for like 200, right? Okay. And who is short? Anybody who's short? Who wants to be the short person here? No one wants to be short? You were. Okay. What would you do?
Try to find the lowest price.
What?
Try to find the lowest price.
No, I would not do that. I would say sell it first, I would call our broker and say, I don't care the price, just sell it at the open, okay? Like just sell it. Look, these guys are waiting to sell it. Sorry?
Why would you, if you were short, so you have a stock loan to you, you would want to sell it immediately?
Immediately, as soon as possible.
So you can get the money to buy it. Why would you sell it?
No, you sell it, sorry, the technical term is you cover your short. Cover your short means you buy it and then you return the stock to the owner. Both things at the same time. You cover your short, right? You probably just say, like the price, like I almost don't care. This is going to explode. Like do it as quickly as possible, right? So the order book would look like what? You know what the order book is? The order book is the orders to buy and sell. And the order book starts to form before market opens. So the order book will have what? Lots of buy orders, right? Yeah. And of course, the buy orders, some of them have a price, some of them don't have a price. So if a buy order is for 250, right? Then what happens? Then you get filled and you said 200, then you get filled too, and you're still waiting, right? You see? And then at open, this trades immediately. So you pay whatever, maybe you get maybe you get hers at 200, okay? And then someone else probably gets his at 250, right? And you're, well, I don't know. But the stock goes up because all the short sellers are buying. What makes the stock go up is the short sellers buying. If no one is buying, then the stock doesn't move, right? So it's the short sellers. They're all competing with each other. They're all running for an exit. Yes? That's a short squeeze. That's what's called a squeeze. They're all running for the exit through a very, very tiny door. Yes?
How can they get 31% if that's over? Couldn't the same thing have happened if they said
Okay, so this is the thing. They have options. So there's a broker who gave them those options. So a broker has done something. We don't know what they did. Only the broker knows. But the broker has a contract to deliver these options to them at a price that they agreed upon. What did the broker do? Did the broker enter into forward agreements? We don't know, right? But what we do know is that we don't know what the settlement time was. It could have been in a year, right? What we do know is that between now and the year, a lot of stocks are going to be bought. So it's a bad time to be short. It's a bad time to be short, okay? So stock owners want to sell. What happens when stock owners want to sell? Shouldn't that make the price go down? No, it makes the price go up. Why? Because the stock owners had their stock on loan to the other shorters. So if someone here was short and decided that they're not going to put a buy order, eventually they will get a buy order because we have more than the float is now insignificant, right? And even if you say, I don't want to buy, you're now forced to buy because as the price goes up, the owners want to sell. It's 2008. No stock is going up, only yours, right? So what are you going to do if you're an owner? I mean, all of you placed orders to sell. No one said, no, I'm going to hold on to the stock. There's a chance Volkswagen goes bankrupt anyway, right? You wouldn't do that. So owners, as the price goes up, as the price rises in 2008, they want to sell. And as they sell, then those short sellers who didn't want to cover their shorts, they are forced to cover their shorts. They are called on their loan. And that makes the price go even higher because they have to buy the stock. Yes?
Since they're forced, and this is above the flow.
Say that again?
Since they're forced to sell the stock, is this like a hostile takeover?
No. No one is forced to sell the stock. You're forced to buy it.
Yeah, but that's for the option. Like at some point.
Oh, you're talking about this, the option?
Yeah.
No. You go to a broker. Okay? You can do this now on Volkswagen stock. Said, I want the option to buy Volkswagen stock, and they give it to you, right? Like nothing, right?
Yeah, but because it's higher than the flow.
It doesn't matter. You can go there. I want to. If the broker sells it, I don't know what the broker did to hedge their portfolio. Let's say that they did nothing to hedge it. Let's say it was a stupid broker, right? They still give you they still sold you the option. The broker is not required to hedge the risk they take. If they have regulatory capital to compensate for their increase in market risk with the regulators, that's their problem, right? So, because this was done by the CFO of Porsche. He is the one who announced this. It wasn't the broker. So Porsche had an agreement with the broker to do this.
Yeah, but it's like Porsche is like taking over Volkswagen.
Yes. Yeah, it is. Maybe this thing will have to wait for regulatory approval, who knows, right? But the announcement was made. I don't know, and I don't know anybody who knows. No, sorry, that's not true. I know people who know everything about this because there was a Canadian company involved in doing this. Okay, and I know them. So some people knew a lot about this. They were but I don't. Okay, and I don't think I will ever be able to find out. Well, maybe, who knows? Maybe one day we will know the whole. I suspect a lot of it, but I don't want to say. I suspect what happened, but I cannot say. Very interesting situation, right? So these things happen. So the stock rose even when people wanted to sell it because that stock was on loan. So it had to be bought first before they give it to you, right? And then you say, oh, now I'll sell it. Okay, so they rose to 186%. So all of you would be filled. All three of you would have been filled on your sell order, right? You would have paid the most amount of money. No, except you.
Too greedy.
No, too greedy. You didn't get filled, but you got filled. You made the most amount of money, right? That happened October 27, 2008. It's a very interesting case. It explains how short selling works. I hope you understand. Yes? So it's not like buying a negative amount of stocks. No. When you buy, no one can force you to sell. Right? When you short sell, they can force you to buy. That changes everything. There's no waiting, by the way. So, it's 2008, I don't care. Volkswagen is going to go bankrupt anyway, right? Well, you won't get to live to see the bankruptcy, right? You're going to be forced out of this. Do you have a question?
I was just going to ask, so I know obviously there's the GameStop thing, but are there, I guess, I was just going to ask what's an example of a short selling working really well, but is that somehow the mortgages?
No, short selling, an example of short selling working really well? Lots of examples. I mean, if you were short selling auto companies, you made money until November. Well, actually, no, even that was around the time, maybe just a few days. No, it was just before GM went bankrupt, right? So the people who did short selling on that, they did great. Yeah, no, short sellers, it's very risky though, but they can make a lot of money. Yeah.
I wanted to ask, what happens if you're short selling and the company goes bankrupt?
If the company goes bankrupt, then technically you have to buy the stock and give it back to the owner, right? So after the stock goes bankrupt, stocks still trade, okay? Sometimes they even trade for more than pennies. Sometimes, I remember during the Hertz bankruptcy in 2010, 8, 9, the stock traded for even went up to $2 at some time, okay? But you buy it and then you buy it very cheap, right?
But you don't make any money. You have to give the stock back.
You have to give the stock back, yes. But but when you short sold it at 50, you keep that cash. That's yours. Right? I'll give you another example. I don't know if I told you, there was a short sell we did on Blockbuster bonds, bankrupt bonds. Do you know Blockbuster, the company? Anybody? Okay, you're all old enough to remember Blockbuster? Okay, right. Maybe you went there as children to rent maybe videotapes, maybe? Okay, so Blockbuster was another example of a company that went bankrupt in 2008, right? They went bankrupt. You know why they went bankrupt? What?
Netflix?
Two reasons. Netflix was only one. The main reason is that they had a very interesting business model, which is they wanted to make money on the real estate. They owned the actual building where their stores were. It's a typical investment strategy. Have you heard of this restaurant, Nobu? The very famous, well, that's the strategy. They buy the building, they put the restaurant, then the building goes up in price, and then they sell it, right? So they were trying to do something like that. Blockbuster owned those buildings, but they have a lot of debt. In 2008, the debt was massive, and those buildings were, worthless. So they went bankrupt because of the revenue challenges caused by Netflix, but also because of their real estate portfolio. The real estate portfolios brought them down. We were short the bankrupt bonds of Blockbuster. In fact, our manager, I forgot the exact number, but let's say that our manager shorted them at $0.20. recovery rate is 50. Kind of crazy, right? Because if recovery rate is 50 and you short them at 20, you're gonna lose 250%, right? No, but the manager was convinced, no, this bond is a zero, it's gonna go to zero, there's gonna be zero recovery. That was a bet on recovery of the bond. And yeah, we made a lot of money because the bond went to zero, and all of that short went into the positive P&L.
So
Yeah.
you say the bond goes to zero, you have to buy it and give it back.
Yeah.
So it doesn't technically go to zero, right? It goes to something very small, or like what
Yeah.
does that mean?
I don't remember. 5 cents maybe?
Okay.
Okay. 5 cents. Yeah. Okay. So, yeah, I think I'm going to have to move a little bit. So there is actually a short selling strategy. There are companies, and some companies, that's all they do. I knew of a hedge fund in New York, 3 employees, all lawyers. What they do when they go to work all day is they look at SEC filings, the Securities and Exchange Commission. Sometimes they say, well, this company has to do this company has to do that, right? So, well, then you short sell the company that does that. Did you read the news about Trump this morning? Okay. It's a bit complicated. He has a massive fine, like $450 million he has to pay. Yeah. So a SPAC, a special purpose acquisition company, forgot the name, it just bought his social media company, Truth Social or something. You see that? Yeah, they merged, and that creates his on the books value for his stake in his social media company at over $3 billion today, right? And today that the parent company, the SPAC that was created for this, went down 15% in value. Okay, why did that happen? Well, that happened because there was an indictment against Donald Trump, right? And then Truth Social is one of his assets. So there's a law firm that what they do is to just look for dirt in the news, in the SEC filings. Whenever something bad is happening, they say, oh, that's bad for these guys. And then they sell the company. They short sell, that's it. And then over to the next one. See what I mean? You just short sell companies as the announcement comes up in the hope that some of those trades work in your favor, right? You just look for dirt and you short sell. Sometimes you're right. You have to be fast, you have to be good. Yeah? Okay. You can build a large language model to do that for you automatically, Just look for negative sentiment in some publication and say, all right, so that's something you can do. It's very risky. And one of the reasons why it's risky is because not only there's a short squeeze, which we mentioned, is sometimes, and a good example of that was, I think it was Nokia. There was a time when Nokia was floundering, It was like the preeminent cell phone maker until the iPhone came out. And then Nokia had really nothing to sell, just a piece of junk, right? Who would buy that? And then the price started to go down and down and down. And so, you know what? I'm going to short Nokia because it's, it's the future of traditional cell phones with buttons is done. Let's say that's your trade. Understand my thesis? Yes? Here comes Microsoft and says, damn, we missed all of this cell phone business, because they did, right? Apple did it right, and Microsoft just missed the cell phone business. So how can a company like Microsoft start the cell phone business from scratch? It's very difficult. So what do you do? And that's what they did. Well, we buy Nokia, we throw those handsets to the garbage, we don't need them, right? But we use the company, and then we create the operating system for a new brand of phone. You see what I mean? When that happens, what happens? They can buy Nokia. Would they argue on the price of Nokia? They probably wouldn't. To make sure they can buy, but they have to buy the whole company, right? They don't want any remaining shareholders there. So if they want to buy the whole company, what do they have to do? They have to give it a good price. They're not going to go there and say, oh, maybe we can save 15 cents. You don't want to take that risk. So, right, you give, if he's trading at $100, whatever it was, they said, you know what? I'll give you 120. And they're like, what? Sure, here you go. Finally, I'm done with my Nokia stock, right? Imagine that. Well, if you're the short seller, what happens to you? You just lost 20%, right? And it was a good trade because this company is going nowhere, except Microsoft have different plans. So this could happen. And this is not a short squeeze. You just, something unexplainable happens. Companies go up in price by 2 times. Why? Because someone says, I want the company. It means nothing to me. It's very small. I buy the whole company. I just pay twice market price so I can get it done quickly. I have no shareholders. I buy every stock. No one will disagree with the price. I just get all of it. Well, the short sellers get not squeezed, no. They get screwed, right? They lose 100%. So that's the risk for short positions. And so this is, by the way, on the squeeze, this is the number that you look at. This is the definition of the float that I presented earlier. It's called the short interest ratio also. Okay. So short positions give you unlimited liability. That's the risk they have. If you own a stock, your liability is limited to how much money you invested. When you go short, there's unlimited liability. If the stock goes up by 300%, you're going to lose 300%. Okay? But still, because it's not an activity which is very common, there are people whose expertise is on short selling. Okay? Short selling gurus, and there's a number of them. All right. Now, with that, we have seen now, at this time, we have seen how you buy and we have seen how you short sell. Let me put them together, and then I create the style, which is called the equity long short trading style. I have here an example of a portfolio that would be an equity long short portfolio. I have some stocks listed here on the right. And here I have the value. You can see that the shorts are in red because these are negative positions. Yes? So this portfolio is long Apple, is long Bank of America, is long Citibank, Dell Corporation, blah, blah, blah. Is short Google. It's also short this thing, which is called QQQQ. You know what that is? QQQQ. It's a ticker for... It's a ticker for an ETF which mimics the NASDAQ index. So that is there because you have a number of positions in in technology companies, so you want to hedge the technology exposure with the NASDAQ. Makes sense, right? And you can see that the short position on the NASDAQ is almost $1 million, which if you count just Apple and Dell, you take the short Google into account, and this, you say, well, that's about right, right? You're short selling an amount which is more or less like your exposure to technology. And then how about the rest? What is this SPY? What's the SPY? That's the other short. What is it?
It's also a trust company. It's a fund or trust.
It's another ETF that mimics the S&P 500. So that's the broad index. Right, so you have positions which are long on, Bank of America. You have other companies here, right? And all of these, they're not really in a particular sector. That's a Walter Industries. They're in a particular sector, so you just do the broad market hedge. Your portfolio has, I'm making this up, about $14 million of exposure on the long side. So I'm going to have a short of $14 million on the short side. And that somehow balances my dollar exposure of my portfolio. You understand? So what's the thesis why you bought Apple and Bank of America? What's the thesis there? We don't know. Could be fundamental, growth, momentum, something. You just don't want exposure to the market. The market could go up or down. You want to hedge it, right? So these are hedged. Our long positions are in black. Those are clear. And Google is what's called a single name short. These are the risky ones. Right? Google is unlikely to go up by 20%. It's unlikely to be bought by Microsoft. But they are single names. They can go up by a lot in one day. So that's why this position is so small. All right? It's called a single name short. This is It's an index short. Index shorts are less risky. Okay, I cannot imagine the S&P going up by 100% in one day. That's like, no, right? Something happened to the US dollar that day. That's the only explanation. Can happen. So that's that. And then this is what's called a sector hedge. So these three shorts that I have in this portfolio, they come from different perspectives. One is a single name, and there isn't only one. There's typically many, but in the example I created for you here, I have a single one. That's all I needed. Then I have, and again, remember, single name shorts are risky. Okay, Nokia, bought by Microsoft, my God, right? Index shorts, whether they are for a sector or for the whole market, they are less risky. So it's okay, you can have them there. Yes? That's how you put this portfolio together. And now what I need to do now, and this, so the interesting question is, let me ask you, the interesting question is, how much money is in the fund? Let's say that this is the portfolio of that fund. How much money is in the fund? We know the value of the stocks, long and short. How much money is in the fund? I didn't write that anywhere. Let's say that you add all those numbers and the answer is 15 on the long side and 15 on the short side. How much money is in the fund?
I think it's 30 because you also need to pay deposit.
30? You think it's 30? Yeah? Okay, you think it's 30, right? Okay, so she thinks it's 30. Anybody else thinks it's 15?
150 maybe.
How much?
150.
150?
Yeah.
Sorry, I don't understand. 150?
Yeah, sure.
So I have 30. So I have 15 million on the long side, 15 million on the short side, and you are saying that total value of the portfolio is going to be, the total cash in the portfolio is 150 million?
Yes.
Okay, that's fine. No, sure, yes, why not? Okay, it's a strange answer, but 150 million.
I'm thinking that like if they are doing some shorts, like they are very risky and something. Like
No, no, it's fine. No, I understand. You're a very careful person. I can see that. Yeah. Okay, so I got two answers, 30 million. I have 150 million. Okay, any other answer? How much?
50.
50 million. You say 50 million. Okay, another careful person here. Okay, great. Anybody else? Any other answer? How much? 100. Oh, another careful person here. Oh my goodness, this is a very careful people here. Very careful people. All right.
Mathematically, it seems like you should just have 0.
Okay, so 0. Do you want to go with 0?
Plus 15 and minus 15.
Plus 50. Say 0. Say 0. So I have all possible answers here. No one said 15. Anybody goes for 15? Okay, this question is the most important question. And this is what I want to talk about now, because everything we've talked about has had to do with the process of buying and selling, but there was nothing about portfolio construction. And as you will see in my next example, this is the question we need to understand. So I'm going to answer this question, I'm going to go to a very, very, very simple situation. Very, very simple. Instead of 20 stocks like I have here, I'm going to have 2. One long, one short, okay? Just that. We're going to understand the case of one long, one short, and then we will understand, then you will understand all the complexities involved in putting a portfolio like this together. Not only the complexities, but also the juice that we get out of making the right decision. And only hedge funds can do this. Mutual funds, by the way, they cannot do that. If this was a mutual fund, I don't know how they would have their shorts. If there was a mutual fund, the mutual fund would have to have about 30 million. Okay? But as we will see, hedge funds. So let me assume this situation. There's 2 stocks, A and B, that's it. They're both equal, they're both worth $100. And let's say I have $1,000 in my account. And I like A, I don't like B. but they're both worth the same. So I put together a portfolio which consists of 9 A's long and 9 B's short, let's say. Yes? Okay? All right. How I came up with this is not an issue right now. Okay? You can do this through your fundamental analysis, your growth analysis. It doesn't matter to me. Let's say that I'm right. I knew it. A was good and B was. So A went up by 10% and B came down by 5%. All right? Okay, I was right. Let me see what that means. I'm going to do my conservative trade. And by the way, this trade is more conservative than almost any of you. So, no, it's less conservative than almost any of you. You were much more conservative than me. All right, so let's say I have $1,000. I have $1,000 now, and let's say in a year it's $1,000. Okay? I'm going to assume 0 interest rates in this example. All right. 9 A's will cost me $900, which is no problem because I have $1,000, right? And after a year, my $900 of stock become $990. Yes? Great. My 9 shorts of B will cost me $900, which after a year will cost me a little bit of money, will cost me $45 because they went up by 5%. My short went up 5%, right? Yes? Okay. Now, I'm not particularly unhappy that my short went up, right? I'm happy. Why am I happy? My short went up. Because my trade was not that B was going to go down. My B was that B was going to do worse than A. Right? I'm happy because I was right. A went up more than B. If they had gone down, and I was right, maybe A would have gone down by 5% and B would have gone down by 10%. I would be just as happy. Because my thesis was not that A or B would go up or down. My thesis was that A is better than B. Right? And the net is that I will make $45 no matter what, as long as A is better than B. Let's say I'm going to, this is a very important number now, $9. Let's say I'm going to pay 1% short selling interest fee to my broker or to my stock lender. Okay? 1%. It's a very high number. Usually it's like 30 basis points, 35. 1%, no problem. It's easy to calculate, right? So I pay that, and now the result is that I make $36 or a return of 3.6%, right? So this portfolio under this makes me 3.6% return. Okay, that's my first scenario, my first trade. Now, who thinks this is a good number? Who thinks this is a good number? 3.6. What did the market do? Huh?
The market went to the time.
What's your guess for what the market did?
Like maybe A and B are from the bull sector and there's something that benefits the entire sector.
Well, maybe. Give me a number.
Sorry, what number?
Give me a number. What did the market do? What's your guess for what the market did? Anybody has a guess?
So the market went up 7.5%.
That's my guess, 7.5%, right? You can say, well, maybe this, well, yeah, I don't know, but 7.5%, that's my guess, right? So if the market went up by 7.5%, my portfolio went up by 3.6%. Is that good or bad? Who thinks it's good? Who thinks it's bad? My goodness, what do you think is bad? This is very interesting. You're comparing my portfolio to the market, right? Yes? And you're looking at the return only. You forgot everything we saw last week then, right? What's the risk basis for my portfolio versus the market? Let me ask you another question. Imagine imagine A would have gone down by 5% and B would have gone down by 10%, right? What would the market have done?
Went down by 7.5%.
What would my portfolio have done?
Gone up 3.6%.
All right? So in that case, you think my portfolio was good? The thing is this, and this is the first thing we need to learn, right? We saw that last week. Remember Markovits? When you compare performance, you have to take the risk into account too. We don't know what the risk of this portfolio is, but clearly it is not related to the risk of the market. In fact, we very quickly went through linear regression and this and that last week, very, very quickly. What's the beta of my portfolio to the market? 0. 0.
It's beta correlation?
Yes, 0. So comparing my portfolio to something which is uncorrelated to, comparing the performance is the wrong thing to do. So we don't know yet if this portfolio is good or bad with respect to the market, but certainly comparing the 3.6 with the 7.5 is the wrong comparison. That we know. Okay? So my advice, never do that again. Never compare the performance of two things whose risk profile is completely different. If we learn that today, I'll be very happy with that already. Yes? But there's more to learn. The more to learn is that if you look at this conservative trade, we had $1,000, and you could argue, why do we need money, like you said, right? When I short my B, I get $900, which I can use to buy my A's. So I could conceive another trade, I'll call it the aggressive trade, in which I only have $500, but I'm going to do the same trade with only $500. You can say, I want to buy 900 A's, I don't have enough money, I only have 500. So no problem, because I'm going to short my, I'm going to short my B's, and shorting my B's means that I'm going to get $900, which I can then use to buy my A's. Yes?
So in practice, what you're saying is you borrow the amount of B's you need to make $900, and then you immediately take that money and buy the A's.
No, I'm not saying that. I'm not saying that. I'm not saying that. Okay, so let me stay with my thesis. My thesis was, I like A, I don't like B. And I'm going to buy the same amount of A as I short B. That's my thesis, right? Yes.
Sorry, this is maybe a not good question, but is the thesis that you like A and don't like B, or is the thesis that you like A more than B?
Sorry, you're right. The thesis is that I like A more than B. Okay, I think A is going to do better than B over time because of whatever the reason. Sorry, that's my thesis.
Sorry, I might have missed this part because I came late, but I was wondering for short selling, after I sell short, don't I need to pay some kind of deposit to ensure that I'm able to buy it back later?
We're not going to get into that.
Okay.
The answer is no.
Okay.
The answer is no. Okay, your collateral is a different issue. Very likely this fund has other assets, other money. I'm just looking at this trade. Okay, the answer is no. How you convince the bank to lend you money, and in fact, I want to see examples of how this actually happened in history. Okay, so I could do this trade with $500, very likely, because although I don't have enough to buy my A's, with a short selling of B, I have enough, so I could do that. And in that case, if I do that, my return is now 7.5%. Sorry, 7.2%. Because I make the same $36, but now only on a $500 investment, right? And why not, let's consider I call the impossible trade, which is what you thought we could do. Why can't we do this without any money? In which case we get a rate of return of infinity %, right? So let me compare these three trades. And I want you to understand this is very, very important, okay? By the way, if I go back to you said you wanted to have 150 million for my previous trade. So that would be like, instead of trading with $1,000, you'll be trading here like with $100,000. Fine, no issues, but it's a very big number. It's a very, very conservative trade, even more than what I would consider to be a conservative trade. Okay. By the way, when I go to my aggressive trade, the return is 7.5%. The market return we saw was 7.5. Right? We already saw we cannot compare just looking at performances. But what's your sense of that trade? Your sense? But essentially that it's almost the same return, and certainly the risk is lower, right? So I think this is definitely a better portfolio than the market. Although it's very hard to compare. You cannot compare them because they have zero correlation. You cannot compare, right? But this looks like a very attractive rate of return. Now, which one do we want? Maybe I could have a vote here. You should vote for the first one, right? Yeah. Who else? You. I think you should. I think you vote for that one too. Maybe you vote for that one too, right? Yeah. Who votes for the first conservative trade? Who would do that? You would do that, the conservative trade? You had to do the conservative trade, man. You were even more conservative than this. I don't have an option to put like a tiny fraction of my capital to this trade. Okay, who goes for the aggressive trade? Well, and who goes for the impossible trade? You go for the impossible trade for sure.
Why not? Make it 50%.
Exactly. Why not? Why not? Okay, so let me tell you, there's a lot of interesting history here. Let me give you this impossible trade. I'm going to use a caricature of the impossible trade. It's a caricature. Okay, it's not true. It's not a true depiction of what actually happened. But remember a fund that became very famous, long-term capital management. Anybody knows that name? Long-term capital management. It was the hedge fund of the time. It had two very famous directors, Myron Scholes and Robert Merton. Yeah, who people thought they were trading. They were not trading. The trader was John Meriwether, who was a very, very reputable bond trader in Wall Street. Very reputable. So he had a hedge fund where he was doing not stocks like this. He was doing interest rate instruments. Okay, they were doing swaps. They were doing mortgage IOs. They were doing off-the-run bonds, on-the-run bonds, stuff like that. But I'm going to use a caricature of what they did, or what he did, John Meriwether, that is, which is you go to a bank, okay, and say, I want to do this trade. We're talking about the year 1995, 1996, yeah? I want to do this trade. If you're a bank, now you are a bank now, okay? If you're a bank, what do you say to a hedge fund like him who wants to do this trade with no money? What do you say? You're a bank. You have to change now your mindset. You're a bank now.
I don't want to let you.
What?
I don't want to let you stop.
You don't want to do this, right? But he's John Meriwether. He's a very famous guy. He's made so much money. And you know what? You're the bank. You make $9. You make $9.
Like regardless of the outcome, I'm making $9.
Yeah.
But what if they went default?
What?
What if they went bankrupt?
Well, if they went bankrupt, this is your collateral. What's there is your collateral, right? So I can see that you will not do that deal. Anybody would do that deal?
I can ask like $20 of the short selling fees for him.
Oh, you want to do this, but for a higher fee? Yeah, this is very smart. That's very, very. So let's do that. Let's do that, okay? Said, sir, I'm going to give you this for $20, not for $9, okay? I'm going to double the fee because of the increased risk. I said, fine, I don't care, right? Look at my profitability, right? Yeah? Okay, so let's say you're Goldman Sachs, let's say and what do you do that? Because you want to make those $9. What, 20 in your case now? That's a very good, I like that answer, that's a very good answer. You'll do for 20, right? So Goldman Sachs does it, Morgan Stanley does it, Bear Stearns does it, B of A does it. They'll do it, right? Why? Because, well, if I don't get that business, someone else is going to get that business. Apparently, everybody got that business. They just didn't know that everybody else was getting that business too, right? And then 1998 came. In 1998, there were two events that happened in 1998. In August of 1998, this happened the same week. First was the default of the Russian debt, of the Russian bond, which created tremendous disruption in the credit markets worldwide, in particular in the United States. And Clinton was impeached in Congress because of the Monica Lewinsky case the same week. And that just dried up credit markets to the point that what happened they had a very good strategy. If they had been able to wait 30 years, they would have made the money. Like what we're saying here, A rose and B rose. This was guaranteed after 30 years because they were bonds. Okay? You know after 30 years, you're going to make money. Understand what I'm saying? These are like stocks. No, here you're guaranteed because you're buying the bonds below market and you're selling the bonds. You're buying you're buying bonds below market and you're selling them above market. You just wait until they mature and you're going to make the money for sure. So it was a great trade, you see, and that was why the banks were not particularly concerned, because they know that as long as you have this is going to make money at the end of the day, right? Okay, what happened is that they were dislocated, prices were completely dislocated, and this dropped in price and this went up in price to the point that it was too hard for any bank to bear. And then is when they realized that the whole portfolio, with all the banks combined, was over $1 trillion in bond notional, which is a lot for 1988. Even today, it's a lot. It was like bigger than the whole bond market in the United States or something like that. Okay, similar to the Volkswagen situation, right? And that caused a tremendous disruption to the market, and they had to unwind the portfolio, blah, blah, blah. But there was a time when this was possible. It was a matter of your negotiating power with the bank. And like what you said, you pay $20, you will get it, maybe. Huh? I mentioned Basel II in my review of risk management a number of weeks ago. You probably forgot. Well, Basel II was created because of this trade with long-term capital management and the New York-based brokers. And it was how credit risk became regulated, is when banks were forced to assume the credit risk of their customers, in this case, the hedge funds. Okay? So this would have been possible in 1987. Today is not possible. This is possible maybe, and that certainly looks possible. So let me tell you how these things happen. What the banks do is they require what's called initial margin, which maybe is what you were referring to, I don't know, but require initial margin. And the initial margin is typically something like this. You're going to require 50% collateral on your long trades. They will lend you the rest of the money. And they're going to require 80% collateral on the short trades. They will loan you the rest of the money. Okay? So in that case, if I go to my trade, what I have is, with this collateral, I have the collateral I need for my stock, $900 A is $450. That's my collateral requirement. My collateral for B, my short in B is $720. The collateral for shorts is higher than for longs. We already saw the risk profile is higher. Footnote, always think of the risk profile. Always. Always. Okay? So since I have income of $900 when I short sell B, that leaves me with a required margin of $270. So in principle, I can do this trade with $270. Not with 269, but yes with 270. And if I do that, then this is what my financials would look like after a year. I made the same amount of money as before, $36, and that gives me a rate of return of 16%. Okay? That's pretty good, no? So who likes this trade now? We have one trade was the impossible trade. We cannot do that. But now we have the conservative, we have the aggressive, and we have this. Anybody likes this trade? Huh? You like that trade? Okay, well, there's something with this trade.
Again, at this point, do we have any risk metrics? It's easy to say it's a good trade after it happened.
Well, that's what I'm going with. That's where I'm going to. That's where I'm going to. Okay. I'm getting so many phone calls as I'm talking to you. It's very, very disrupting for me. Okay, I'll try to focus on the lecture. Okay.
Are the calls about trades that they want you to do?
Sorry, what?
Are the calls about trades?
These are all my students. They're all students calling me. The students calling me. All right. No, had nothing to do with the trades. No. No one on Zoom insisting that I do a trade or something like that. Okay. So let me, we're near the end, okay? And at the end of this, we'll understand how to buy and sell stocks, finally, okay? The initial margin is there. Let me tell you something else. There's also what's called a variation margin, which is as I make and lose money, they're going to increase or decrease my margin requirements, obviously. You're right? Okay, good. So let's say that I have my portfolio with my $270 trade, as you were, I think you were saying that, right? That's your you're doing your $270 trade. You have your A, you have your cash, then you have your stock A at $900. Let's say that A drops in price by 50 bucks. Let's say B stays the same, doesn't change. Then you still have your short selling fees, which is not a big deal, $9. And now your variation margin is you need to put up $50. What do you do now? What do you do now? You are in a negative collateral situation. What do you do now? This is what's called margin call. This is a margin call. The performance would have been great if I could wait, but I can't. I have to pony up this amount of money before the end of the day. I have less than 24 hours to come on with this money. What do we do? In fact, let me tell you something that did happen on October 13, 2007. Okay? So let's say that this was, there were a number of hedge funds. You were all hedge funds, right? And you all went to the same university. You all got the same lecture by, not me. I'm not teaching you how to pick stocks, but let's say that they all taught you the same metrics, earnings per share. If it's this, then you buy it. You all went to the same class. You all know each other, by the way. And you're all long A and you're all short B. Same A, same B. Yes? Yes? But what made your funds different is that some of you had the conservative trade with $1,000. You were one of them for sure, okay? And others, you did this trade with $270, like you and others. Yes? Right? Okay, so who are you? Are you the $1,000 trader or you're the $270 trader? Who are you? Who's the $1,000 trader? No, you're the 270. You can't change your mind now. I need someone on the other side. So who's the $1,000 trader? You are. Yeah, you're the conservative. Who is the $270 trader? You guys there. Yeah, exactly. Perfect. You're the risky guys, right? Okay. Let's say I'm Goldman Sachs. And guess what? I also went to the same school as you. I also am long A and short B, except in much, much bigger numbers than you, right? And it's 2007. That was the beginning of the subprime crisis, and a lot of my clients want their money back, so I have to sell a lot of A's and buy a lot of B's to give the money to them, right? Yeah? So I pick a very quiet day in the summer. No market volatility that day. Was a very quiet day. And I decided to dump a lot of A's and cover my shorts for a lot of B's. What happens when I do that? This. Except it's a bit worse because B goes up. Right? And then all of you who were short people, all of you who are doing this trade with $270, what happens to you? You get a call from the broker, said, I need money, right? What do you do when you need money?
I mean, it depends on whether or not you have the money, but you have to decide if you want to sell A or just take some money from your initial fund, right?
You have no more money. You are fully invested, right? That's all the money you have. You have no more money. When I say that you invest when I say that you have $270, that's your cash account. That's all you have.
Take up a loan. Take up a loan.
You have less than 24 hours. No one's going to lend you any money. Lending money to a hedge fund is something that you don't do. They have no assets, right?
Sell some of the assets
What?
Sell some of the assets to the other hedge funds so you can follow.
You have to sell assets. You have to sell to the market. You don't sell to the hedge funds. You can't do that. You have to sell to the market, right? So you have to unwind some of your positions. That's what you have to do. So you have to cut your loss. And you're crying because, damn, I am going to make this money. My trade was right. It's just something bad happened in the market today. And that happens. It happens all the time. But you have to do it. You have to do it. So A goes down in price, B goes up in price. You have to liquidate, all of you in sequence, as you get your margin call, which means that you are going to lock in your losses without being able to recover. Right? What do you guys do? Those who have $1,000 or even more, you have $10,000 in the bank account. What do you do? A is going down, B is going up. What do you do?
We can buy their compos.
What?
We can buy their compos.
If I was you, first thing I do is I call the broker. They are great sources of information. You need to understand what's going on because this is very weird, right? You call the broker. Say I'm the broker. You call me. Say, sorry, I cannot, like people are calling me now, right? So I cannot talk to you. Why? Are you lecturing? No, I'm not lecturing. I'm issuing a margin call. Then you know. Said, remember that guy? He was in class with me. Such a big risk taker, you know. I'm sure he was long A, short B. Of course, it makes sense, but I'm sure he was at $270. Then you know what's going on, right? You have to know what's going on in the market. Otherwise, something bad could happen to you. You have to know. And then you know. And then what do? Now you know. Now you know some people are in trouble. Now you know there's a fire sale on A and the opposite on B. Fire sale on A and the opposite on B. What do you do now?
We're going to cut the loss as well. We're going to cut the loss as well. Otherwise,
You?
the price of A would drop much faster. And then
I would buy A's. I would increase my risk tolerance a little bit, and I would buy $1 of A's and short sell $1 of B's. That's what I would do.
But how do you know they're selling when the selling will stop? Like
You just wait. You wait. Maybe tomorrow. You do tomorrow. You just say, well, looks like the nosebleed is over, right? It's a nosebleed. These guys are having a nosebleed, right? And you know it's over by the end of the day.
I see.
Right? So maybe by the end of the day or maybe tomorrow morning, say, well, I think it's time to buy more A's to stretch my risk tolerance a little bit. Right? Good. All right. So now comes the question. And this is the important question I want to leave. It has no answer. But this is the important question, which is given everything we've seen here, what is the right trade? What is the right amount of money to have here? 271? 275? 500? 1,000? A million? What's the answer? What's the answer? This is an answer we haven't, this is a question we haven't seen before, right? The risk is we run out of money and we get into a margin call. But if that will have to be fairly sudden, right? Let me ask you a question, which is, we don't want that. What is the probability that I have a margin call, given that I have a certain amount of money in excess of 270? What's the probability of that? That's a question you all have seen in your probability course. You may have seen in your probability course something which is called the running maximum of Brownian motion. Have you seen that? Have you seen the reflection principle? Oh, then you've seen this. Then it turns out that if I have an excess initial margin of A, if A is 0, the probability I get a margin call is like 100%. But if A is bigger than 0, it's smaller, the bigger the A is. So my portfolio, let's say that my portfolio is normal, is Gaussian with a mean mu and standard deviation sigma, let's say. Okay? So we understand this. Then the probability I get my margin call is this. This is a consequence of the reflection principle. Of course, if A is 0, the probability that I get a margin call is 100%. If A is bigger, is much, much bigger, then it's going to be smaller. Right? So this is a way to measure another risk we haven't seen yet. This is not standard deviation. This is not credit value at risk. This is not maximum loss. This is something new, which is the margin call, the probability of a margin call. And like this, there's many, many risks in everything you do. And every time there's a new risk, you need to calculate it. Here's an example of a risk we have not seen before, linked to stock trading, and that's how we deal with it. So now you go to your risk tolerance and you either do your trade maximizing or minimizing the collateral needed, but making sure that this probability is within your safety margins wherever they are. And that's how you would decide how much money you're going to keep. The answer depends on your risk tolerance, right? The answer depends on your faith in the market and so on and so forth. Okay, this is all I wanted to say for stocks. It took me longer than I thought. So we're going to take a 10-minute break now. So my next trading style is convertible arbitrage. Convertible arbitrage is a trade that is based on bonds, and it happens for companies of a certain type. I need to tell you about convertible bonds, what they are, and why it matters to us. What does a company do? What does a company do when they need money? What's the first thing companies do when they need money?
Issue bonds.
Exactly. You borrow money. You use someone else's money. We already saw that on, I think, the first day of class. What if that fails? You issue stock. What if both fail? If both fail, then you're not in a position to choose. You're going to end up with another. If you're lucky, you will raise money with a deal which is going to be worse for you than stocks or bonds, and you have to give your funder, your lender, your investor, you have to give them the best of both worlds. So what's the best of the bond world? Safety, recovery rate. What's the best of the stock world? Upside. So to encourage people to give you money, then what you're going to do is you're going to give them a bond that they can turn into stock whenever they want. That's a convertible bond. It's a bond that can be converted into stock. Now, these bonds are typically issued by companies that have difficulties. If the company has no difficulty, they can raise money with debt, no problem. If not, well, maybe with stocks. So these are typically done by companies that have an issue. And it gives rise to a very interesting type of trade called convertible arbitrage that I want to explain to you in some detail. Credit is the biggest issue here. Credit risk is the biggest driver for profitability here. And I want to explain to you how this works. I'm going to explain the case of a single trade where we're going to be buying the convertible bond and we're going to hedge the default risk of the bond by shorting the stock. And you will see that it gives us a very interesting trade, but we need to short the stock for that. We already saw the risks and dangers of stock shorting in the first half of today, so that's going to come up to light also in this context of convertible arbitrage. And with some luck, we will be studying how to optimize a trade. I think I'll have time to do all of that. Okay, but I'm going to do that with an example. I'm not going to talk about this in general I'm going to use a particular example for that. I'm going to use an example of a convertible bond, which is sold for $80. That's a 20% discount. Indication that the company is not, very creditworthy. The company has a traded stock at $7, which and the convertible bond has a convertibility feature that allows me to trade the bond into 10 common shares for $8 a share. Obviously, I'm not going to buy the bond and convert it immediately. I lose money. I lose $10. If I buy the bond for $80 and I convert it into stock, I could, but that's only going to give me $70, rather have the bond, right? I'm also going to make the bond a bit more realistic now with an annual coupon payment of $4. I'm going to assume interest rates are 4% in alignment with the bond, and I'm going to assume a short selling interest of 1%, same as before, because 1% is a very easy number to work with, okay? So in that context, I'm going to build a trade which is as follows. That's what I have. My convertible bond is at 80 and my stock is at 7. So my convertible bond I will buy for $80 now. I'm going to short sell 10 shares of my stock. We'll talk about why we're doing 10 shorts. We don't have to do 10 shorts, we could do 5 shorts. Okay, I'll explain to you why we're doing 10. And then when I do 10 shorts, I pick up $70 in cash. Because interest rates are 4%, it's not a good idea to hold that cash. That perhaps gives me very little interest return. So I'm going to buy T-bills. That's what typically is done for cash management. T-bills are very safe. They still are safe. They're becoming a bit more shaky every year. But let's say I buy T-bills, they give me 4% return. So with my $80, that's my trade. A year later, let's say that nothing has happened. My bond still trades at $80. My stock is still trading at $70. My 4% coupon and my 4% return on my cash is there. And then I have fees of $3.50 because I have to pay 4% borrowing rate plus 1% shorting rate for my short stock. That's $3.50. Okay? That means that if nothing happens in a year, I will make $3.30, which is not a very impressive rate of return because it's giving me essentially a 4% rate of return that I could earn by buying the T-bills and not doing any of this stuff. So clearly I'm not going to do this trade because I think this is possible. But if nothing happens, everything is the same. That's the value of this trade. Not interesting. Let's say this happens. This is very interesting now. Let's say that the company goes bankrupt. What happens if the company goes bankrupt? My bond trades at, let's say, recovery rate $50 or $30. That's up to you. Okay, we're modeling this, so you pick a number. I pick 50. My short stock is now trading at 0. So there you go. I've already made $70 there. My coupon payment is nothing. It's part of my recovery rate. My T-bill still gives me the 4% because the government, the U.S. government has not defaulted. So I get $2.80. And I pay $3.50 in fees, just as before. The net result is that I make $119.30. Sorry, the net result is that my portfolio is worth $119.30. That gives me a return of 46% over the risk-free rate of return. This is a good trade. This is a good trade. Clearly, I think we now understand why we shorted 10 stocks. Why? We shorted 10 stocks because I guess we were convinced that this was very likely. Right? So you can think of this differently from buying a convertible bond. You can think that this is a way for us to short the company because we make money when the company goes short. Why didn't we just short the stock? It seems that the implied view of this trade is that I wanted to profit from the company going bankrupt. So if that's the case, why to do this such a complicated trade? Why didn't I just short the stock and then have 100% return? Why not? If the company is bought by Microsoft and suddenly they pay $2 per dollar on a share acquisition, then not good, right? But in this case, I'm saved because I have my bond. I convert my bond into stock. And yeah, I mean, my coupon payment will give me the $4, and then, no, I don't get the $4 because I turn the bond into stock. So there's no coupon payment. I turn my bond into stock. So the result is that I lose 60 cents. Big difference, right? So with only two scenarios, you can begin to understand why we did this trade. What we really wanted was to short this company. But shorting a company, we already know, is very risky. So instead of shorting the company, we buy the convertible bond. And then we short sell all 10 shares. So we are really betting on the company going bankrupt. If you see the analysis, we could have shorted 9 and would still do very well if the company goes bankrupt, right? And here we would have done slightly better. So this was a trade where we are furiously approaching the scenario, or furiously betting on a scenario which is that companies go bankrupt. Yes?
If a company doesn't have convertible bonds, but has both bonds and stocks, you can do the same thing.
No. The company needs to have a convertible bond. This trade only works for convertible bonds. In fact, I'll give you. This is coming up later, but I'll tell you now. This was the trade to do in 2008 and 2009 with the banks. The banks needed cash. They were undercapitalized and they needed cash. The first thing they did in 2007, the US banks mostly, what they did is, the Canadian banks no, but the US banks, what they did in 2007 was issue debt. I knew of a bond issue in 2007 where they were offering 25% yield on the bond. No takers. 25% return. Interest rates was like 3, 2. No takers. Okay? What do they do after? All banks, they issue debt. They issue stock. All did that. Goldman Sachs, Morgan Stanley, Citibank, they all issued stock. What happened? Stock plummeted. The first stock issue worked, but when the stock plummets to nothing, you cannot raise money with stocks, because for every stock you sell, you get $1. Big deal, right? So bonds didn't work, then stocks did not work. Around mid-2000, sadly after Lehman, in the fourth quarter of 2008, neither stocks nor bonds worked. What did they do? Issue convertibles, right? In fact, this was perhaps one of the, I'm not a historian, okay? I know, I lived through all of this. I was managing a lot of money those years, so I was very much in the market, but I didn't have enough information to know exactly what happened with Lehman Brothers. But Bear Stearns, who went bankrupt before Lehman, they issued convertible bonds aggressively, and that maybe helped them. And eventually they were bought by JP Morgan. But I think Lehman was not so actively issuing convertible bonds as perhaps they should have. And the rumor is that the Fed was not particularly happy with that that lack of fundraising spirit on the part of Lehman, and maybe that's why they were, no bailout was encouraged for them. That's the rumor. I don't know if that's true. Okay, but if a company is having difficulties and they cannot raise money with bonds and stocks, the company will say, well, we issue convertible bonds. Otherwise, that would be the end, right? So it's realistic to assume that a convertible bond is available for trade. Not always convertible bonds are done by companies in trouble. Sometimes there's other reasons, but capital structure considerations, who knows? But this is the typical situation. Good question. Okay? All right, so this is the flip side of what we said earlier. And here you say, oh, damn, Microsoft bought Nokia. Well, I got my Nokia convertible bonds, so I'm still okay. I lost a bit of money, right? But I'm still okay. You understand? So in this case, it's interesting because the convertible bond looks like a hedge against my short position. Unlike the wisdom, the common wisdom, which is that the stock is the hedge against the convertible bond. Now we'll see more. I have some other, so here I get, I lose 4% with respect to interest rates, but I could have lost 200% if I just do a short, right? So I have some other scenarios. Usually bonds and stocks go together up or down. So here I have a situation where both the bond goes down and the stock goes down too. And my coupon payment is alive and well. My T-bill gives me some risk-free rate of return. And I still pay my fees to the bank. And the result is that I make a little bit of money. Obviously, I tend to make better when the bond goes down and the stock goes down than when they go up, because I was betting on bankruptcy, right? So here I can see that I make some money. If the performance is 4% over LIBOR on the first case and just flat LIBOR in the second one, if things get better for the company, I tend to do worse, right? And if the company, say the bond goes up, the stock goes up, then I do my financials and I see that indeed my performance is a little bit less, but still not bad. Okay, still, I mean, I didn't lose a lot of money. If I'm betting on bankruptcy, this is what happens. Well, okay. And the question is, well, what is the right trade? If I'm betting on bankruptcy, what is my right trade? So this is one way of doing this, and this would be a way to optimize the trade. Imagine, so this is how you would decide what convertible trade you do. And this is going to look very familiar because it's linked to the portfolio construction approach we saw last week. We come up with some scenarios. Okay, I say, how did you know these scenarios? I have a scenario that says there's a 33% chance that the company is bought by Microsoft, say. There's a 33% chance it goes bankrupt with a recovery of $30 per bond. Or there's a 33% chance that nothing happens. These are my three scenarios. How do I know this? Well, I hired some of you and I paid you some money to do this analysis, and that's what you gave me. So I said, must be pretty good. They took APM466, they know what they're talking about. Or they took MAT1856, they know what they're talking about. Yeah, that's what people do. And this is how you model. You can do the analysis, and then, is there a magical formula to go from your analysis to this? No, there is not. But this is a way to get your machine started, right? You can do the analysis. Well, this might happen. Microsoft looks like they are interested, maybe not. I don't know. You come up with this. Once you have this, then the problem of optimizing the trade becomes a very simple problem in optimization. How would you do it? I have the solution coming up, but how would you do it? What you do is you do accounting for each of these scenarios. That is my, these are my views. So I'm going to call X the number of stocks I'm going to short in my portfolio. It's a number between 1 and 0, between 0 and 10, or I want to say X% of 10 in my convertibility is 10 stocks. What percentage of my convertibility budget I'm going to put into my hedge, and then I build my accounting as a function of X. In scenario 1, this is the value of my portfolio. I'm not going to go through this, it's just accounting. That's the value of my portfolio in the second scenario and the third scenario. I have the total value of my assets. So what I can do is I can calculate, for example, the Sharpe ratio as a function of X. I have the expected return and have the standard deviation as a function of X. So I divide by one by the other, right? After all, maximizing the Sharpe ratio is what made you $1 million, right? Yeah. So you see that you maximize the Sharpe ratio when the hedge is about 80% of the, so when you hedge with 8 stocks. With these views, the result is that you short 8 stocks based on these views. You understand? So this is scenario-based optimization. That's what you do here. Not hard. The key is, where do these numbers come from? That's what analysts do. And people get paid a lot of money to come up with these things, because when you have that, this is very simple. Yeah? Okay, great. So this is one example of how we do convertible trades. Here is a very famous trade. It's the Citibank convertible trade in 2009. We also participated in that. And there's one thing that I want to mention here, only one thing. The rest is just technical information. I'm not interested in that. This is a trade that happened in early 2009. I don't know what you were, I don't know how old you were in 2009. Maybe you don't know any of this, but in 2009, Citibank traded one day at 99 cents. Citibank traded one day at 99 cents. Okay, if it had closed under $1 the next day, would have been kicked out of the New York Stock Exchange. It was bad. It was very, very bad. Everything was bad. Citibank was called Shitty Bank that day. Okay, that's how people referred to it. But Citibank still exists, and they're doing great. How did Citibank somehow recover from that one day in March when they traded at 99 cents? Do you know? Have you heard of the bailout package of the US government? Have you heard of that? You don't know that the banks were bailed out? You don't know? Yes? Did you know how that bailout happened? That's how it happened. I'm going to show you. This is very, very interesting. Very, very interesting. So let me tell you what did not happen. What did not happen is that the U.S. government through the Fed, what did not happen is that they gave money to Citibank. Not really. What they did is they bought convertible bonds. Okay? So, well, it's the same thing. Well, yes, it's the same thing, but just wait. Something very interesting happened here. Very, very interesting. They bought convertible bonds. I have the details of the convertible issue here. They were sold for about $30, $35, I seem to remember. Okay, $34, $25. That was the price of the convertible bond, and they could buy shares at $320 a piece. So the total conversion rate was about at par. The face value was $50. You could buy it at $34. It is kind of 15%. Okay, but then you could buy shares at maturity in the more or less in the way that we have seen here. Now, what trade do you do? Well, if you're the US government, what do? You just buy the convertible bonds, right? And then you can convert them into shares at maturity, right? And then you sell the shares. But if Citibank goes bankrupt, then what happens? You lose all of it, right? So the U.S. government, they only bought the bonds. Obviously, the U.S. government, the Fed cannot short, bank shares. They cannot do that. That's right now. But investors do. So what did investors do? What did we do? What do you think we did?
Do it before, like we buy the bond and short sell.
Yeah, we bought the bond and short the stock. Shorting the stock hurt because the stock was very, very cheap. It was not at 99 cents. It was at about $3 or $4 at 365. So shorting stock at 365, I seem to remember these were very short dated bonds. I think the maturity around July of the same year, only 4 months later. So the stock then was the stock was at 14 or something like that. I'll give you numbers that I remember. I don't know what's written here. I seem to remember the stock was at 14 at that time. So it went from 4 to 14. That's a 400% loss on the stock, right? But it still was a very profitable trade. I remember that. So imagine how profitable it was for the Fed. Right? This was a very profitable trade for the Fed. In fact, it was one of the trades in which the Fed made a lot of money. So this bailout was really an investment in the banks, and the Fed made a lot of money on this. They lost money in some other bets that didn't work, but this one was very, very profitable. Even hedging the stock at $3.65 was profitable. You understand how this works? So this is not only trading, this is public policy now. How does the regulator bail out a bank without really spending, actually making money in the process? And that's how it happened. Is that clear? Okay, great. All right, so these were the two main styles that I wanted to end with. I think this gives you a very good flavor how things happen. You know how to build portfolios long and short. You know how to do implicit leverage by margin financing or margin-based trading. You have seen how to short the stock without getting burned if the stock doubles in price to convertible arbitrage. This is how things work. And of course, you have seen how to create a snow fund by creating very innovative investment structures, as we saw last week. Okay. Now, but you're not the only ones. This happens. I have the history here of convertibles. There are many, many more trades like that. Here I have an example of merger arbitrage. Alcatel and Lucent made a merger announcement. What they did is they saw that if they are going to merge two companies which have different credit ratings, then if they merge, then the rating will converge. So then you make money on what? On the bonds, because the credit spread will converge. So you buy one, sell the other, and then wait for convergence. We've seen that already. You know how to do that. The process is very similar to what we have seen today. So that example would work. There's one that I want to skip over this. There's one that I want to end with. It's not this. Oh, this is very interesting. Just before the euro was created, there was a lot of demand for euros to the extent that the euro became more expensive than each of its individual constituents, and the exchange rate is guaranteed. So what happens when you see that? Well, what you do is you short the euro and you buy the underlying basket of currencies, and you wait until the euro is official in February, and then you make money, right? As another example of this is a convergence trade. But the one that I want to spend more time on is this, and then I'll end with this example. This is the case of George Soros that you may have heard. George Soros is a very wealthy Hungarian who common wisdom says, again, something wrong. Common wisdom usually wrong. Common wisdom says that he made a lot of money by forcing the UK government to devalue the British pound. That's common wisdom. Okay, if you think about that, that is impossible. No one can force a government to devalue your currency. Certainly not an individual. Okay, what he did is something very different, very, very different, and he was not the only one doing that. And this is interesting for you to understand, because this type of trading is called macro trading, and it's the same as what we saw earlier called fundamental stocks, but you do it not with companies, but with governments, with currencies, with interest rates, with sometimes commodities like gold, right? He did it with a currency, with the British pound. And he wasn't the only one. This was chatter among the financial sector. Everybody knew that. Is the precursor to the euro was something called the ECU, European Currency Unit, ECU. Okay. Actually, the only reason the euro is called euro and not ECU is because ECU in German means a cow, and you can call a currency a cow in Germany. So that's why the euro was created. The word euro for the euro was created. But as you know, and as we have observed through history, Europe was particularly interested in having the UK into Great Britain into the European Union, and in particular into the European Monetary Union. Okay, Britain to be part of what later became the euro. And to achieve that, what they did is they inflated the value of the British pound in that currency basket. Okay. It was a way to attract Great Britain into the euro. Understand what I'm saying, right? And then people say, oh, but that trade's not going to work well, right? You can do that to entice a country from joining, but eventually there's going to be dislocations. So what they did is they betted against that. They betted that there will be convergence back to normalcy. And then you do your analysis. And people did different analysis, but some people say, well, according to my analysis, they are giving the British pound, 20% more value than they're entitled to, or 15% more value than they're entitled to. And of course, you don't know. And of course, you could have gone wrong. And of course, the British pound could have converged and become part of the euro, and then you would have lost all of your money in that bet, right? But what happened was the opposite. What happened is that macroeconomics really took hold. And in September of 1992, the macroeconomic situation was untenable, and the British government decided to devalue the British pound by 20% in one day. And they said, well, I knew it. And then you make, $1 billion or whatever amount of money he made, okay? But this is not, again, it's not that you cannot make money by betting against the company, for example. The fact that you go short, yeah, it does make the company drop in value a little bit, but once it goes down in value, then that's it. You have your liabilities to give it back to the original owner. The same with currencies, right? Understand? But I think you now understand how this trade works. It's the same as the Volkswagen short, except in this case, you are shorting a currency because you think that the currency is overvalued with respect to what? With respect to the other currency that is convergent against. I told you the example of the euro versus the other currencies earlier, right? What if the euro was so expensive and the currency so cheap because it was actually miscalculated, and in the 3 months that remained until the convergence of the euro, they have to change the conversion rate? Would have been a political disaster, but you would have lost money too. This was a political disaster, and they actually made money because they were betting in favor of that political disaster. You understand what I'm saying? Okay, so it's another example. It's became very well publicized, very public. I may have time for the last case. This is, I call it a blended style because there was a mix of different things that happened. It was a very interesting situation. It happened in the week of March 17, 2008. This was the week in which the first near default of a US bank happened in the 2008 crisis. And that was with the broker, Bear Stearns. Bear Stearns, on Friday, March 14, there was a negotiated takeover from JP Morgan of Bear Stearns that was floundering and having a very big toxic book in it. Rumor says that the Fed, actually no, this is not a rumor, this is documented. So the Fed had a deal with JP Morgan that JP Morgan could buy the whole bank for $2 a share, and some guarantees, some loan guarantees, and then some leniency on the regulatory capital until they could fix some of the toxic stuff inside the books of Bear Stearns. It was a controlled bailout. And then the week after, I lived through this also as a participant. The week after, something very interesting happened, which is the stock of Bear Stearns jumped. At some points was traded, like in Wednesday, was traded like at $5. So why is someone paying $5 for a stock that's going to close at $2? As soon as the shareholders approve the transaction? That's a very interesting question. Why would you pay $5 for a stock that has been agreed over the weekend that it's going to be worth $2? Why would you pay $5? This is what happened, and this is very, very interesting. Okay, again, a lot of this is rumor. I mean, these are news that you read, but I collect this news that happened, and then I tell it to my students. That's what I do. Okay, it's very interesting. I think it's true, but even if it wasn't, it's still interesting because this is very, very probable. There were hedge funds that were selling protection on Bear Stearns. Very expensive. I have the number here. Very expensive protection. But what happens if Bear Stearns is bought by JP Morgan? That protection you sold is not a claim coming. You lock in your gains, right? Right? That would have been the most profitable transaction. You're selling protection on Friday, and then on Monday say, I keep all those premiums for me forever because Bear is not going bankrupt ever, right? Understand? But there is a problem. What if the shareholders vote against the takeover, right? What happens if they vote against? So what you do is say, wait, I need to make sure that shareholders vote in favor. So what I do is I buy stocks and I vote in favor. So you buy stocks, and how much you pay is really not so relevant because your trade is not to profit from the stock purchase. Your trade is to ensure that the premiums you collected on your credit default swaps stay with you untouched. You don't have to pay any premium. Understand? So I call this a blended sell because this is not something you can say, well, it's this or it's that. No, it's a bit like the snow fund. It's just some idea that it occurred to you, and it's not convertible, it's not anything. It's just a way to deal with risk and minimize your possibility of losses. Unlike this, there's many, many others. But I think today, I hope you got a very good description of the different strategies. Yes? So you feel like you could go and open your own hedge fund now? Maybe? Okay. Well, if not opening your hedge fund, you can certainly work for one now. So you have, I think, a pretty good idea of the kinds of activity that goes inside, right? So, okay, that's good. All right, so finish class. We actually finished the finance part of this course. What remains is next week, and that is communication skills. Without next week, everything you've learned, not so useful. Okay? I hope to give you the key to turn what you've learned into something useful. We'll see that next week, April 1st, same time.